Happy New Year. Welcome to 2021. This is J.R. St. Julien with the Campbell Real Estate team of Keller Realty, and I'm here to give you my personal San Diego housing market predictions for 2021, so stay tuned. Now, before we can get into the San Diego housing market predictions for 2021, we have to look at what the hell happened last year. Because last year was a crazy year on all fronts, specifically in the San Diego housing market. It didn't go anything like what any of us expected once the coronavirus hit the market in March of 2020. So let's chat and dig into that a little bit and get some insights into what actually happened this past year, so that way we can inform ourselves about what we can potentially expect going forward. So while the world was going through a global pandemic, the economy was contracting in many different sectors, and the unemployment rate was shooting to the moon, the real estate market was booming in 2020. And I can tell you, in March of 2020, when Corona hit the market, no one expected what the outcome would be, or that the outcome would be what it is today. So we're going to kind of dig into a little bit about what just happened. Let's look at some stats from the San Diego Association of Realtors. In the last year, we saw appreciation rates sitting at 14.7% year over year as we wrap up 2020. 14.7% year over year. Going into the year, no one expected that. After the coronavirus hit us in March, at the end of March, and we started shutting down the county and shutting down the country at the end of March, no one expected in any way, shape, or form that we would see this level of appreciation numbers as we rounded up the year. But sure enough, that's what we got by the end of the year. One of the biggest reasons behind that is that I do believe there was genuinely a COVID effect that hit the market. And what do I mean by that? So basically, after people were told to stay in their home for extended periods of time, they were basically trapped in their home with all of their family members, including their young kids, all day. A lot of folks realized that, hey, I need to do something a little bit different about my living environment. I need a bigger home. I need a home with more rooms. I need a home with an office. Maybe I don't want to live in a condo anymore because I don't like walking through these hallways with all these other COVID potential positive people. So a lot of different decisions started being made based on a new operating environment that we're operating in, and we expect to be operating in for some time to come. So that was definitely one aspect that changed, and that definitely affected the demand component of that supply and demand equation. And one way I can visually show you what that demand looked like that we found was actually pretty interesting, you can see on this next slide. So this next slide tracks the showings of homes that are on the market. So basically, Showing Time is a scheduling platform that we will use to kind of help us coordinate the showings of our listings. At least many agents use them, not all agents, but many agents. But these numbers will just give you some relative idea of what the activity, what the buyer demand was looking like how often were people going through homes to view the homes. That's one way to determine what the demand is for the homes in that particular market. Now, this slide is specifically for the West region, so it's a little bit more than San Diego, but it still makes the case. You can see we started out the year with a little bit higher demand than what we kind of normally would get, especially in January. Coming into 2020, we expected to have a really good year. But then you can see when COVID hit in March, the demand pretty much dropped off the table. Now, that being said, despite that drop, that very distinct and very significant drop, basically we went from where we should have pretty much peak demand in that particular time of year, that spring time of year, that's when we should see the highest level of demand. We went from what we should see to going down to a little bit below the lowest level of demand that we would typically see during the year, which is like during the Christmas time frame. And so if you look at the slide, you'll notice that it was a very, very, very steep drop off. And we saw that, we felt it. Now, that being said, despite that drop off, the market still appreciated during that time frame. The homes that were available on the market were still selling. The market was still moving at a normal pace, and everything was still continuing as if COVID wasn't going to really have anything to do with the real estate market. And that's what we actually saw. We were actually kind of surprised to see that. So then you'll see on the slide, in June, when the world started to open back up, specifically, the Western region, you can see the demand spiked and it went through the roof, and it was beyond anything we had seen in prior years during that time frame. And all of a sudden we had this large wave of buyers that came back into the market, and that just further exacerbated the market and appreciation rates that we were seeing at that particular time. Now, the other component of that demand equation is specifically being driven by the current mortgage interest rates. They are literally sitting at lifetime lows, lows that we've never ever seen before. And it's a great opportunity for anyone that's looking to lock in a 30-year fixed loan on a home, because you're going to lock in a rate that is, at this point in time, sub 3%. Now, if you look at this next slide that I'm showing you here, you can see back in 2018, we had rates that were hovering in the 4% range. And between 2018 and 2019, that rate started to kind of creep up toward the 5% range. Now, when we hit that 5% range, there was a little bit of a pause in the market, and then the rates started to settle. And pretty much since we hit that 5% mark, they've been just coming down and coming down and coming down. Now, again, coming into 2020, we saw the interest rates were low. They had been on pretty much a steady decline since 2019, and we expected it to kind of continue. Well, when the COVID market hit, you can see there's a little bit of an anomaly in the rates slide there, because no one knew what to expect when COVID hit. So kind of everything went a little crazy for about a 1 month period. The buyers stopped coming for the most part. I mean, there's still some out there. Some lenders shut down certain loan programs. Some lenders weren't sure what to do. The rates were changing drastically every single day. So every time we went into the office, we get an update from the lenders, and the rates are drastically moving up and down, up and down, up and down. And you can kind of see that on that particular chart. Well, what happened after that is the Federal Reserve stepped in. So in March, the Federal Reserve said, hey, we're gonna cut the Fed funds interest rate down to 0 to 1/4%. So basically, we want to target somewhere between 0 and 1/4% for the Fed funds rate. Simultaneously, they said, hey, we're going to make sure this credit market, this mortgage market keeps moving and keeps cycling, and the money can keep flowing. And to help do that, we're going to buy up a boatload of mortgage-backed securities. So basically, between March of 2020 and September of 2020, the Fed bought over $1 trillion, not a billion, $1 trillion in mortgage-backed securities in that short amount of time frame. Matter of fact, they bought around $300 billion in March and $300 billion in April, just to make sure those markets stayed open and things could start moving again, and all the lenders weren't locked up with fear. Well, that actually worked, because kind of as we came out of March, early April timeframe, lenders were kind of filling themselves out, and they started getting back to normal business, and they kept things moving. So that plan actually worked, and the Fed did a good job with that. Well, they continued to buy at a rate of around $100 billion per month after April, so like, May, June, July timeframe, etc. And then right now, currently, they're buying around $40 billion a month of mortgage-backed securities. So they're still investing in that market to make sure those funds keep moving, but you can see they've been tapering that down a little bit, because at this point, the market's been moving very well, and those purchases are not needed as much as they were back in March and April, when things kind of started to lock up and people started to freak out for a little bit. So their plan worked. So that plan, combined with the dropping of the federal funds rate, caused the mortgage interest rates to drop as well. And now we're seeing mortgage rates in the sub 3 categories, obviously depending on your particular situation. But a lot of folks are getting interest rates below a 3% interest rate. And you lock that in for over a 30-year period, you're winning, no matter what the market is. So that's the basic demand component of what we saw in 2020. And the cool thing about that is we expect that to continue for the foreseeable future. In December's Fed meeting, they said, hey, we don't expect to change the interest rates through 2023. And that's unusual. That's not common for them to forecast that far out. But basically, they're telling us, hey, this interest rate environment, it is likely to stay around through 2023. And that's a good thing for the market, because that's going to keep everything turning, keep everything moving. And therefore, we kind of would start to expect to see some similar activity in 2021 as we did in 2020. Now, of course, demand is only part of the curve. So we got to look at the other side, the supply. When we came into 2020, we also saw something that gave us a feel to say, hey, I feel this year is going to be a good year for the market. And one of those things was we had a low supply of inventory. Now, it's good in the market from a sense of appreciation, making it a little bit easier to sell homes, etc. But it's not so good for the market if you're trying to shop around and buy a home, because you're kind of limited to what you can find and buy. But we're dealing with what we're dealing with. And so if you look at these next slides, you will see that the inventory levels were pretty steady coming into like mid 2019. You know, we saw a little bit of a bump in 2018, especially the detached home sales. But for the most part, in kind of 2019, that's kind of when we saw a major shift in the inventory in the San Diego market. Specifically, it fell off the damn cliff. So now we're looking at inventory levels that have fallen 50.3% in the detached market category and 31.8% in the attached market category year over year as of December 2020. That's incredible. Basically, we just lost half of the inventory on the market. So now you saw the demand levels, they went through the roof, but the supply levels were basically cut in half. That created a perfect formula for appreciation. And that's what we saw in 2020. So now let's talk about 2021. So we're coming into 2021 with basically the same supply and demand economics that we had in 2020 that caused the real estate market to boom. Now, a lot of folks are wondering, hey, have we hit the affordability limit? So if you look at this next slide, the housing affordability index, and basically what that is, that's essentially telling you, hey, the median income earner, so the median income earner can afford blank percent of a median price home based on that housing index number. So if it's 50, it's 50%. If it's 80, it's 80%. So basically what that means, the higher the number, the better, the more affordable the homes are. So if you look back at the trend, and you look at year over year for December, you can see we've decreased in our housing affordability index by about 5%. So there's some change, and yes, the homes are getting slightly less affordable, but it's not drastic. It's not even close to the 14.7% of appreciation that we've seen. So that's definitely something to keep in mind. And so the moral of that story is I don't believe that affordability is really going to have an impact yet on this market. We haven't got there yet. Our affordability levels are sitting fairly close to what they've been for the last few years. They moved down a little bit, but that's not a significant enough change to cause a problem in that regard. So now we can jump past that affordability conversation and get back just to pure supply and demand. So based on supply and demand, we expected the housing inventory to remain low because number one, COVID is still here. So we're not expecting a large influx of homes coming onto the market. There are a lot of sellers that are still resistant to putting their home on the market because they just don't want strangers walking through their home during this time of COVID. Maybe that may change after the vaccine takes place, but we have so much demand that we have to absorb. I don't believe there's anything that we can do in our current market to serve and to fulfill that demand to a point to where it causes the market to cool off. Now, on the interest rate side, as I mentioned before, the Fed has said, hey, we're going to keep these interest rates low till 2023. Therefore, we're not expecting any major changes in the interest rates. Now, if the interest rates did suddenly go up to 5%, I would say that would definitely be enough to cool off the market, at least the demand side of things. But we don't see that happening anytime soon. And the Fed has already told us we're going to keep it low to at least 2023 to make sure the economy has time to fully recover from this. So the moral of the story is we expect this market to continue to appreciate. We expect this market to continue to be competitive if you're trying to buy a home in this market. We expect this market to continue to garner sellers some great dollar values for their homes. I mean, we're basically setting records whenever we sell a home in any particular neighborhood. So if you're thinking about buying, you know, it's a good time to buy if you're positioned for it, and you can do so because you have the opportunity to lock in those interest rates at lifetime low levels. And really, that's almost like free money. Not totally free, but almost like free money. And then on the sell side, if you're thinking like, hey, I need to downsize, or I'm ready to get out of this house, or I'm ready to move to a different area, this is a perfect time to do it because of all of the other reasons that we just talked about. And we are netting the most possible money for our clients right now because we know how to dress them, we know how to make them look pretty, and we know how to sell them. So if you're thinking about buying or selling, to be honest, despite that this is a huge seller's market, my prediction, this is a great time to do it. And I expect the next couple years of the San Diego market to be very lucrative for homeowners. And remember, homeowners' net worth, based on NAR statistics, National Association of Realtor Statistics, is typically 45 times that of a renter. And the reason why is because homeowners get to take advantage of this appreciation that we're seeing in the current market. So home ownership is the way to go. Please reach out. Let me know if you have any questions. I'm here to serve all of your real estate needs. I love to work with you, love to talk with you. If you have any friends or family that's thinking about buying a home, definitely reach out and let me know, because I love to give them the service that you know I will provide. So look forward to talking to you. If you have any questions about what I just said, or the market, or any particular community inside of San Diego County, I'm here to help. Give me a call at the number below.